Long-term growth guidance has been between 20 and 25% for last 9 years. We have grown in that range, so we continue to maintain that both the asset as well as the profitability will continue to be in 20 to 25% range going forward as well. Any higher guidance will depend upon the market allowing us, like it did over last 2-3 years. But we stand by our guidance of 20 to 25%.
Okay, what about the impact on FY19 numbers?
So FY19 also we believe would be the growth that company would show would be within these 20 to 25% compounding. So we believe there is good asset availability, and the liquidity situation, which in the short term may remain tight, will soon come back to normal. There was a large Indiabulls conclave yesterday where it clearly came out there is enough liquidity in the system, and for the organizations like ours, which have no ALM mismatches, huge retail granular pool which is very liquid, NPAs less than 1%, there is no concern as far as any of this debt capital not being made available. So we believe that the 20 to 25% growth rate, even in tight liquidity, is something that we will be able to achieve. In case liquidity situation improves dramatically from here, the growth rate may tend to uptrend.
Okay. If you could tell us what is the kind of sell down of loan portfolio that you've done in the second quarter, and what's the plan over the next 2 quarters, and if the sell downs would largely be on the corporate and LAP portfolios?
So the securitization is an ongoing program for the company, where we sell our home loans and loan against property. A large part of these loans form priority sector for banks. The target for this year is 13,000 crore, out of which we've already sold 5,000 crore. So in the balance 6 months in these 2 quarters, we need to sell another 8,000 crore. For this quarter, I think that number will be 4,000-5,000 crore.
Okay, in terms of strategy, has there been any conscious effort to bring down the lending or the disbursements on the LAP and corporate books, and if there has been any sort of a stress build up that you're noticing on either of these portfolios?
So till such time there is liquidity shortage in the market, we would be conservative in our disbursement. So we are definitely continuing to disburse to home loans, and in a very measured way to LAP and commercial loans. But till such time there is full availability of liquidity, the disbursements will be continued in a measured way. I don't think so loan against property in the segment that we are, which is very prime, backed by the owner's house, small business owner's house, purely on cash flow, a 10-year-old business, seasoned with a lot of banks as far as credit is concerned. That kind of a loan against property portfolio will underperform any of these scenarios. They have been stress tested over global financial crisis. They have been stress tested on 2013 liquidity crisis, recent demonetization, recent GST. So that portfolio behaves very well with NPAs less than 0.5%, and I believe it will also continue to do well. Corporate book also, 70% of our corporate book is covered by lease rental discounting, and the balance construction finance also should continue to do well, as home loan disbursement in the system have not come down. Banks are more than around 60% of the market, and even the larger housing finance company continue to disperse. So there is no concern on the residential construction finance as well.
Fair enough. So your spreads for the second quarter were maintained at about 3.24%. That is the higher range of your guided spread range of 300 to 325 basis points. But I want to understand what is the kind of incremental spreads currently, after factoring in the the lending rate hikes that you've taken, and what does it do to your guided range for spreads then?
So the spreads have been in range of 3 to 3.25%. For the last quarter, it was 3.24%. The recent rate hikes should widen the spread a bit in the short term. But interest rate is in the floating rate is something that benchmarks keep moving up and down. So as soon as liquidity situation improves in the system, these benchmark rates will come down and the spreads will be over a medium to longer term maintained at 325 basis point.
Okay, Ashwini, I want your thoughts on liquidity crunch for NBFCs. Are you seeing some reluctance from the banks on lending to NBFCs? Has the situation improved over the last 3-4 weeks or not? And by when then do you expect normalcy to return?
So clearly banks are supporting non-banks. We have seen SBI, Bank of Baroda, Union Bank come on media and have expressed their desire to increase the buyout of loan pools. Now non-banks by their very design of nature have been originating liquid retail assets. So it's a good fit for the banks to bankroll and buy these portfolios. So I don't see any stress that NBFC per se will face as far as liquidity is concerned. Market, there is a small crisis of confidence after one of the large infrastructure-based lending platform defaulted on some payment. But that's a very different business. Everyone understands that has nothing to do with granular retail liquid portfolios where the NPAs are between, for non-banks, less than 2% and for housing finance company less than 1%. That there is any concern on the asset side or on the liability side. No housing finance company has more than 12-14% of their borrowing in the short-term market. So clearly, while the crisis of confidence should fade away as mutual funds are flushed with liquidity, they are sitting on 20% cash. Historically, it is more 4 to 5%. So this money will definitely flow back to the non-bank sector. But people would want, few weeks to pass before they start committing their funds. In the interim, banks are buying the securitization pools from non-banks, and that should continue to provide liquidity to the sector.
Okay, Ashwini, if at all there will be any, but what could the possible regulations on ALM mismatches for NBFCs be, as was suggested by the RBI in its monetary policy, and how could that impact Indiabulls housing finance?
So housing finance companies are regulated by National Housing Bank, and National Housing Bank has been at forefront of regulation. All our regulations are exactly in line with banks, or in some cases tighter than banks. So we are governed exactly in line with banks. ALM guidelines are welcome in case there are some mismatches. Market participants have been taking borrowing short term, lending long term, and in case those ALM mismatches get corrected, it is very healthy for the market in the long term. So we are children of regulation, and we welcome any regulation on any aspect of our business, and it will only strengthen the system or the confidence of the system in us. So I'm looking forward to some meaningful regulation which bring better structure to the market.
Right, but Ashwini, could this possibly have to do with the introduction of LCR? There have also been talks of RBI regulation on LAP loans, which seem to have been classified as home loans. I mean, what are the areas that could get regulated, or what are the kind of moves that the RBI could make?
No, RBI would be concerned on the liquidity front, because on the asset side, most of the non-banks are in lending to vehicle finance, truck, tractor finance, SME loans, unsecured personal loans. Housing finance companies have been in business of home loans, loan against property, and developer loans. I don't think so there is any concern on the asset. Home loan versus LAP, the end use of a home loan is the money goes to the seller, whether it's a builder or a secondary sale, whereas in a LAP the money goes into borrower's account. So it takes just a minute for any regulator, and they anyway do their due diligence. So those are more rumor mongering on the asset side. On liability side, yes, liquidity and ALM are areas where some non-banks can surely improve upon, and that's where like banks have an LCR. We have started reporting our own LCR, which versus banks at 140% is more like 400%. So very comfortable, 3 times more liquid assets we have vis-a-vis banks. So those kind of parameters where short-term liquidity, next 30 to 90-day liquidity parameters may be introduced, which is very healthy for the market. As a company, Indiabulls Housing Finance for last 10 years have been maintaining huge liquidity pool. When in September end we had 23,000 crore of liquidity on the balance sheet, because liquidity is one discipline that you can't suddenly comply with when liquidity becomes tight. It has to be an ongoing, and every quarter for last 10 years we have been maintaining this liquidity principle, where 15 to 20% of companies' assets are in form of cash or cash equivalents, and that is enough to pay next 6 months liability with the cover of at least 25%. So that kind of a discipline we have maintained, and it becomes handy in tight liquidity situations like current.